Imagine a company that, on the surface looks like a single independent business. Pretty straightforward.
Yeah, simple enough.
But then as you start to sort of peel back the layers, you realize it's just one piece of a much larger, intricate web of businesses, all interconnected.
Happens all the time with big corporations.
How do you, as an investor or maybe an analyst, how do you make sense of that financial complexity? How do you see the true economic picture?
That's a core challenge, isn't it?
That's precisely our mission today. We're embarking on a deep dive into consolidated financial statements.
Right.
And these aren't just dry accounting rules. They're the essential tools that let us view multiple legally distinct companies as if they were a single economic entity.
That phrase is key, single economic entity.
Yeah. We'll be drawing from key principles found in standards like IS 27, IS 28, IFRS 3, and IFRS 10.
Giving you the practical insights.
Exactly. How parent companies, their subsidiaries, even associated businesses present their complete financial picture. We'll walk you through some real-world type scenarios to help you spot the crucial details.
Sounds good.
So when we talk about a company, we usually think of one legal entity. But how often is that the full picture, especially for larger corporations?
Very rarely, I'd say.
Why do we even need to combine multiple companies into one statement? Why not just look at each one individually?
Well, what's fascinating here is the underlying philosophy.
Okay.
To truly get a handle on the financial health and performance of a whole business group, you need to see beyond those individual legal boxes.
Right, see the whole thing.
You need to grasp its overall economic footprint. Looking at each company alone would just give you a fragmented, maybe even misleading picture.
Ah, I see.
So this approach, consolidation, it ensures transparency. It shows investors the combined resources and obligations that are under common control.
Okay, that makes sense.
So this brings up a really important question. How do you define that group in the first place?
Yeah, where do you draw the line?
It all comes down to the concept of control.
Control.
Yeah.
Okay. And that's where the definition of a subsidiary comes in, right? We often hear that rule of thumb. If a parent owns more than half the shares, it's a subsidiary.
Yeah, the 50% rule.
But how much does ownership really define it? Is it always that straightforward?
Rarely. It's often more nuanced than just that percentage. Well, yes, the general assumption is control exists if you have more than 50% of the ordinary shares or voting power. IFRS 10 clarifies that control isn't always just about majority ownership. It sets out 3 critical criteria, and all of them have to be present for control to exist.
3 criteria. What are they?
Okay, first, the investor must have power over the investee, the potential subsidiary.
Power.
Second, they need exposure or rights to variable returns from their involvement with that investee.
Variable returns.
And third, crucially, they must have the ability to use their power over the investee to affect the amount of those returns. The link is key.
Power, returns, and the ability to connect the two. So it's not just about the percentage points on the shares, is it?
No, not at all.
What else can show this? This power, this control, even if you own less than half.
Well, power can show up in several ways beyond just owning the majority of shares.
Like what?
For instance, an investor might control over 50% of the voting rights because of a specific agreement they have with other investors.
Okay, it's ideal.
Or they could have the power to govern the financial and operating policies maybe set out in a statute or another contract.
Right.
And importantly, power can also be shown by having the ability to appoint or remove the majority of the board of directors.
Okay, controlling the board.
Or even just the power to cast the majority of votes at board meetings. It's really about the practical ability to direct the things that matter, the relevant activities.
That's a lot of nuance to consider. It's not just counting shares.
Definitely not.
Let's try to make this concrete. We've got an example here involving GreenCo. GreenCo holds investments in 3 other companies: Violet Co., Amber Co., and Black Co.
Okay.
First up, GreenCo owns 80% of Violet Co's equity shares. What does that tell us? Pretty straightforward.
Yeah, that one's clear cut. With 80% equity, GreenCo definitely has more than 50% of the voting shares.
Right.
That automatically gives them control under IFRS 10. Violet Co is a subsidiary. Needs to be consolidated. Simple as that.
Understood. Okay, now Amber Co. Yeah. Here, GreenCo owns 25% of its equity shares, but also 80% of its non-equity shares. What's the key distinction here?
You have to be careful here. The focus must be on the equity shares.
Was that?
Because non-equity shares, like preference shares usually, they generally don't grant voting power or the ability to direct those relevant activities we talked about.
Gotcha. So the 80% non-equity doesn't matter for control.
Not for control, no.
Ah.
Since GreenCo only has 25% of the equity shares and there's no other sign of power mentioned.
Like board control or agreements.
Exactly. Then they don't have control over AmberCo. So AmberCo is not a subsidiary in this case.
Okay, not a subsidiary. And then there's BlackCo. This one's interesting. GreenCo holds 45% of its equity shares, less than half.
Right.
But GreenCo also appointed 5 of BlackCo's 7 directors. This BlackCo example really highlights the nuance, doesn't it?
It absolutely does. It's a perfect illustration.
So what's the verdict here?
Well, even though 45% is less than half the voting rights, the fact that GreenCo appointed 5 out of 7 directors, that's the majority of the board.
Which gives them...
It effectively gives them the power to direct BlackCo's financial and operating policies. They can steer the ship.
And that impacts returns.
Exactly. It directly impacts the returns GreenCo gets. Therefore, despite owning less than 50% of the shares, BlackCo is indeed a subsidiary. Control exists.
Wow. So in this scenario with GreenCo, both VioletCo, with the 80% ownership, and BlackCo, with the board control, would be fully consolidated.
Correct. Both are subsidiaries based on IFRS 10. AmberCo is not.
Okay, so once we figured out which companies are part of this single economic group, we merge their financial statements.
Yeah.
But companies within the same group, they often trade with each other, right?
Yeah.
Sell goods, lend money.
All the time. It's very common.
What happens to all those internal transactions and balances? Do they just disappear? Or do they show up somewhere?
That's a critical point for maintaining that single economic entity concept.
Right.
You're right. Entities within a group often have this intergroup trading. It creates things like receivables and payables between them.
Internal debts.
Exactly. And these internal balances must be completely 100% eliminated in the consolidated financial statement.
Completely gone.
Completely. The goal is to only show amounts owed to or owed by parties outside the group, not internal IOUs.
Okay.
If we connect this to maybe a simpler picture, imagine trying to figure out your family's overall financial health.
Okay.
But you're still counting that $50 IOU your sibling owes you from last month.
Right. It doesn't really affect the family's net position with the outside world.
Precisely. It distorts the true external picture of your family's finances. Same idea for a corporate group.
That analogy really helps clarify it.
Okay.
And this next part, I think this is where it gets kind of counterintuitive for some people. Even if the parent doesn't own 100% of a subsidiary, maybe they own 80%. Like in some of our examples, we still consolidate 100% of the subsidiary's balances, assets, liabilities, everything.
Yes. You've absolutely hit on a fundamental principle there. It catches people out sometimes.
Walk us through the thinking there. Why 100% if you don't own 100%?
It goes back to that concept of control. When you consolidate a subsidiary, you incorporate 100% of its assets, liabilities, income, expenses, the whole lot into the parent statements.
Okay.
Even if the parent only owns, say, 70% or 80%. This is crucial because consolidated financial statements are reflecting control over the subsidiary, not just the percentage of ownership.
Because control means you direct all its activities and resources.
Exactly. The parent has the power to direct the subsidiary's activities, so its entire financial footprint is considered part of the group's economic reality. It would be a fundamental mistake to just prorate a subsidiary's balance sheet based on the ownership percentage.
That would misrepresent the economic entity under control.
Precisely. It wouldn't show the full scale of resources and obligations managed by the group.
That makes a lot of sense now, especially with that focus on economic control, not just ownership stake. Let's look at a practical example. PinkCo acquired 80% of ScarletCo.
Okay.
PinkCo has receivables of $50,000 on its own books, and ScarletCo has $30,000. However, within PinkCo's $50,000, there's $4,600 that's actually due from ScarletCo, and ScarletCo has a matching payable on its books.
Right, a classic intragroup balance.
How do we present these receivables and payables in the consolidated statement?
Okay, for receivables, you start by adding them together. PinkCo's $50,000 plus ScarletCo's $30,000. That's $80,000 initially.
Right.
But then you must subtract that intragroup balance of $4,600.
Eliminate it.
Eliminate it. So $80,000 minus $4,600 gives you consolidated receivables of $75,400. That's the amount owed by external customers to the group.
Got it. And for payables, let's say PinkCo owes $70,000 and ScarletCo owes $42,000, including that $4,600 owed to PinkCo.
Same logic. Combine Pink Co's $70,000 and Scarlet Co's $42,000, which is $112,000.
Then subtract.
Then subtract the intragroup $4,600 again. That results in $107,400 for consolidated payables, the amount the group owes to external suppliers or lenders.
So the intragroup balances, they just vanish from the consolidated view. Poof.
Exactly. They net out to zero from the group's perspective, ensuring the consolidated statement truly reflects only external assets and obligations.
Okay. So that covers debts between group companies. But what about profits made on sales between group companies? If Pink sells something to Scarlet at a profit?
Yes, unrealized profit.
It sounds like accounting is constantly asking, are you really making money yet, or are you just, moving cash between pockets within the group?
You've basically got it. That brings us neatly to adjustments for unrealized profits, often called PUP, provision for unrealized profit.
Okay, PUP. When does this arise?
This scenario happens when one group company sells goods to another group company, but crucially, those goods haven't yet been sold onto an external customer outside the group by the year end.
So the goods are still sitting in inventory somewhere within the group.
Exactly. Until that inventory is sold externally, any profit made on the internal sale is considered unrealized from the group's perspective.
And why does that need eliminating?
Because if you didn't eliminate it, the group would effectively be recording profit simply from selling something to itself.
Which isn't real profit yet.
Not from the group's viewpoint. It would artificially inflate both the inventory value on the balance sheet and the overall profit reported to external stakeholders. You can't profit by trading with yourself.
Okay, that makes sense. So the core principle is the group can only recognize profit from internal transactions once the goods leave the group. It has to reflect earnings from external customers.
That's the heart of it.
So what are the key steps for handling this intragroup trading when it affects the consolidated profit and loss statement, the P&L?
There are two main steps you need to take for intragroup trading that hits the P&L.
Okay, step one.
First, you eliminate the entire intragroup sale and the corresponding purchase from both consolidated revenue and consolidated cost of sales.
The whole amount of the internal sale.
The whole amount. Regardless of whether the goods are still in inventory or not at year end, this ensures your consolidated revenue and cost of sales figures only reflect transactions with the outside world.
Right, takes out the internal churn. Step two.
Second, you then make a separate adjustment specifically for any unrealized profit on the inventory that still remains within the group at the end of the reporting period, the PUP adjustment.
Okay, let's try a scenario. Purple Co. sold $5,000 worth of goods to Silver Co. during the year.
Right.
The original cost of those goods to Purple Co. was $4,000. So Purple Co. recorded a $1,000 profit on that internal sale.
Okay, simple profit margin.
Now, at the year end, half of those items are still sitting in Silver Co.'s inventory. They haven't sold them on yet.
So $500 of that $1,000 profit is currently unrealized from the group's perspective.
Exactly. Now, let's say Purple Co.'s total revenue for the year was $79,300 and Silver Co.'s was $29,900. What's the consolidated revenue?
Okay, to get consolidated revenue, you first add Purple $79,300 and Silver's $29,900.
That's $109,200.
Right. Then you subtract the entire intragroup sale amount, which was $5,000.
So $109,200 minus $5,000.
Gives you consolidated revenue of $104,200. This elimination ensures the group isn't artificially boosting its top line by selling to itself.
Got it. Remove the internal sale value from revenue. Now, what about that unrealized profit itself, the $500 on the inventory still held by Silver Co.? How does that get treated? Where does it show up?
Good question. That $500 unrealized profit needs two adjustments.
Okay.
First, on the consolidated statement of financial position, the balance sheet, you need to reduce the carrying value of the inventory by $500.
Why reduce inventory?
To bring the inventory down to its original cost to the group, which was before Purple Co. added its internal profit margin. So inventory is started at $2,500, half of the 5K sale price, minus $500 PUP, reflecting the $2,000 original cost to the group.
Okay. Reduces asset value. And the second adjustment affects profit.
Yes, it affects the consolidated cost of sales. You typically add this $500 PUP adjustment to the cost of sales.
Add it to cost. Why?
Because adding it to the cost of sales effectively cancels out the unrealized profit that was initially included when Silver Co. recorded the purchase, which becomes part of its cost of sales. It ensures the profit is only recognized in the P&L when the goods finally leave the group.
So if Purple Co's cost of sales was, say, $54,990 and Silver Co's was $17,904, how would we calculate the consolidated cost of sales?
Okay, you'd take Purple's $54,990, add Silver's $17,940. That's $72,930.
Yeah.
Then you subtract the $5,000 intra-group sale elimination because that cost isn't external.
So $67,930.
And then you add back the $500 unrealized profit adjustment.
Right, so $67,930 plus $500.
Totals $68,430 for the consolidated cost of sales. It seems complicated, but it perfectly removes the internal profit until it's actually earned externally.
It really is all about presenting that true external performance of the combined entity. Fascinating how these adjustments work.
It's logically consistent once you grasp the single entity concept.
Now, shifting gears slightly, when a company acquires another one, especially if they pay more than the book value of the assets, there's often this line item called goodwill that pops up on the consolidated balance sheet.
Goodwill. Yeah.
What exactly is that? Beyond just being a number, what does it represent and how is it calculated?
Goodwill is, it's essentially the premium paid when acquiring a business over and above the fair value of its identifiable net assets.
So the extra bit you pay.
Exactly. It's often seen as the market's bet on the future value, the synergy, the intangible stuff.
Like what kind of intangible stuff?
Things like a strong brand reputation, a loyal customer base, skilled management, maybe patented technology, or those anticipated efficiencies you get from combining businesses, stuff that isn't easily listed as a separate asset on the balance sheet at the time.
Okay, so it represents future economic benefits expected from the acquisition that aren't individually identified assets.
That's a good way to put it.
So how do you actually calculate it when preparing consolidated accounts? Is there a formula?
Yes, there's a specific formula for calculating goodwill at the date of acquisition.
Let's hear it.
You start with the fair value of the consideration transferred by the parent company, basically what the parent paid.
Okay, the purchase price.
Then you add the fair value of the non-controlling interest, or NCI. That's the value of the portion of the subsidiary that the parent doesn't own.
Add the value of the part you don't own. Why?
We'll come back to that. So consideration plus NCI.
Okay.
From that total, you subtract the fair value of the subsidiary's identifiable net assets at the date of acquisition. Net assets being assets minus liabilities.
Right, the fair value of what you actually acquired in terms of tangible and identifiable intangible assets.
Exactly. And the resulting figure, if positive, is the goodwill recognized on the consolidated balance sheet at acquisition.
Consideration plus NCI net assets, goodwill. Now back to that NCI bit. Why include the value of the part the parent didn't buy in the goodwill calculation? Seems odd.
It goes right back to that core concept of control and the 100% consolidation principle we discussed earlier.
Connecting the dots.
Since the consolidated financial statements present the subsidiary as if it's 100% part of the group.
Because the parent controls 100% of its operation.
Right. Therefore, the goodwill calculation also needs to reflect 100% of the goodwill attributable to that acquired entity, representing the total premium paid for control by both the parent and, implicitly, the NCI.
So you're calculating the goodwill on the entire subsidiary, not just the parent's share of it.
Precisely. Including the NCI's fair value ensures this comprehensive view of the entire goodwill created by the acquisition.
Yep.
It's consistent with consolidating 100% of the assets and liabilities.
Okay, that clicks now. Let's put this into practice with an example. Redco acquired 80% of Blueco's share capital. Blueco had 40,000 shares in issue.
Okay.
Redco paid $3.50 cash per share for its 80% stake.
Right.
The fair value of the non-controlling interest, the other 20% at acquisition, was measured at $30,000.
Got it. NCI is $30K.
And Blueco's net assets at the acquisition date had a fair value of $125,000.
Okay, net assets, $125K.
What's the goodwill?
Okay, let's calculate. First, the consideration transferred by Redco. They bought 80% of 40,000 shares.
There's a 32,000 share.
Right, at $3.50 per share. So 32,000 times $3.50 equals $112,000.
$112,000 is the consideration.
Correct. Now step 2. Add the fair value of the non-controlling interest, which we were given as $30,000.
Okay, $112,000 plus $30,000 equals $142,000.
Exactly. That's the total value attributed to Blueco in the deal. Finally, subtract the fair value of Blue Co's identifiable net assets at acquisition, which was $125,000.
So $142,000 minus $125,000.
Leaves you with goodwill of $17,000. That's the figure that would appear on Redco's consolidated statement of financial position.
$17,000 goodwill. Great, that walks through the calculation clearly. So far, we've really focused on situations where a parent company exerts control over another entity, making it a subsidiary.
Yes, control has been the driving factor.
But what about situations where a company has a significant stake in another business? Enough to influence decisions, maybe sit on the board, but not enough for outright control.
Now you're talking about associates.
Associates.
Yeah.
Right, that's where IAS 28 comes in.
Precisely. IAS 28 deals with investments in associates and joint ventures. It defines an associate as an entity over which the investor has significant influence.
Significant influence. How is that different from control?
It's a lower threshold. Significant influence means the power to participate in the financial and operating policy decisions of the investee, but crucially, not the power to control those policies. You have a voice, but not the final say.
Okay, participation, not domination. If the 50% plus ownership rule is often the main indicator for a subsidiary, though we know it's more complex, what's the general rule of thumb or presumption for an associate?
The general presumption, kind of the starting point, is that significant influence exists if the investor holds between 20% and 50% of the ordinary or voting shares of the investee.
20 to 50%.
But just like with control, it's not just about the percentage.
There's more to it again.
Yes. There can be other compelling evidence that shows significant influence exists even if you own less than 20% of the shares.
Such as?
Things like having representation on the board of directors or being actively involved in the policy-making process. Maybe there are material transactions between the investor and the investee, or perhaps an interchange of management personnel between the two companies.
Sharing managers.
Yeah. Or even just providing essential technical information. It's really about the substance of the relationship and the tangible ability to impact the investee's strategy and operations, even without controlling it.
So it's about influence, not control. And presumably, because the level of involvement is different, the accounting treatment for associates must be fundamentally different from that line-by-line consolidation we do for subsidiaries.
Absolutely. That's the key difference. Because you don't have control, you do not consolidate associates line by line. It wouldn't make sense.
So what do you do instead? How does it show up on the P&L and the balance sheet?
Instead, associates are accounted for using something called the equity method.
The equity method, okay. How does that work in the consolidated P&L?
In the consolidated profit and loss statement, you don't add the associate's revenue or expenses line by line. Instead, any dividend income you might have recorded from the associate is removed.
Okay, no dividend income.
And it's replaced by a single line item. That line represents the parent's share of the associate's profit or loss for the period. It's usually presented simply as share of profit, loss of associate.
Just one line reflecting your slice of their net income?
Exactly. And on the consolidated statement of financial position, the balance sheet, the investment in the associate, is also shown as a single figure, usually under non-current assets.
Okay, one line on the balance sheet too. How is that figure calculated?
It starts with the initial cost of the investment when you first acquired significant influence. Then you add the parent's share of the associate's post-acquisition, retained profits, basically, the cumulative share of profits the associate has earned since the parent gained significant influence, less any dividends received.
So the investment value grows or shrinks on your balance sheet based on the associate's performance.
That's right. It reflects the investor's underlying interest in the associate's net assets. This whole equity method approach underscores that the level of operational integration and decision-making power is fundamentally different for an associate compared to a subsidiary.
Control versus influence. Different economic relationships, different accounting.
Precisely.
Let's try to apply this. We have a few statements here about Indigo Co.'s investments. We need to figure out if they represent subsidiaries, associates, or neither.
Okay, let's test the principles.
First statement. Indigo Co. owns 30% of the non-voting preference share capital in Yellow Co. Associate or not?
30% looks like it's in the 20-50% range.
But
it's non-voting preference share capital. As we discussed earlier, non-voting shares generally don't give you influence over operating and financial policies.
No vote, no significant influence.
Pretty much. So Yellow Co. is not an associate, despite the 30% holding. It wouldn't be equity accounted. It'd likely just be a simple financial asset investment.
Yeah, not an associate. Statement 2. Indigo Co. owns 18% of the ordinary share capital in Blue Co.
Less than 20%.
But directors appointed by IndigoCo hold 2 of the 5 places on Blueco's board of directors.
Now that changes things. Even though it's only 18% ownership, which is below that 20% guideline.
The board representation matters.
Exactly. Having 2 out of 5 directors gives IndigoCo significant input into Blueco's decision-making. It clearly indicates significant influence.
So Blueco is an associate.
Yes. In this case, Blueco would be classified as an associate and accounted for using the equity method.
Right. Board seats trump the percentage rule sometimes. Okay, final one, statement 3. IndigoCo owns 45% of the ordinary share capital of Redco.
Okay, 45% is definitely in the 20-50% associate range.
And directors appointed by IndigoCo hold 4 of the 6 places on Redco's board.
Whoa, hold on. 4 out of 6 directors.
Yeah.
That's a majority of the board. Don't just look at the 45% holding and stop there.
What does the board majority mean?
Controlling 4 out of 6 board positions effectively gives IndigoCo the power to govern Redco's financial and operating policies. That means they have control.
So even though it's less than 50% ownership, the board control makes it.
Makes Redco a subsidiary, not just an associate.
Right, so Redco would be fully consolidated, line by line, not equity accounted.
Exactly. So in this set of examples, Yellowco is neither, Blueco is an associate, equity accounted, and Redco is actually a subsidiary, fully consolidated. Shows you need to look at all the facts.
We've really covered a lot of ground today. Quite a journey through consolidation.
We certainly have.
We started by understanding that fundamental why behind consolidated financial statements, the need to show that single economic entity.
Getting the big picture.
Then we explored how to identify subsidiaries, digging into that critical concept of control and how it goes way beyond just owning more than 50% of the shares.
Power, returns, and the link between them.
Then we saw why eliminating those intergroup balances and crucially unrealized profits is absolutely essential for a true single entity view. Stops companies from profiting from internal shuffling.
Keeps the picture clean and externally focused.
We also broke down how to calculate goodwill that premium paid for future potential and synergies.
Consideration plus NCI minus net assets.
And finally, we distinguished the very different treatment for associates using equity accounting, recognizing significant influence rather than full control.
Highlighting the importance of that control versus influence distinction.
You know, understanding these principles, it really does provide a solid platform for interpreting these often complex financial statements.
Absolutely. It empowers you as a reader of those statements to see the bigger picture of how these corporate groups are actually structured and accounted for.
It reveals the true economic story that might be hidden behind just looking at one company's standalone numbers.
It genuinely changes the way you look at a company's financial reports once you grasp these concepts.
Indeed. So maybe a final thought for you to consider. Next time you look at a large company's financial report, think about this. What else might be hidden in plain sight influencing those numbers? What other entities, subsidiaries, associates, maybe joint ventures, are truly part of their economic story, shaping the reality presented to the world, beyond just what's obvious on the surface of their main income statement or balance sheet?
It encourages a deeper level of analysis, looking beyond the primary statements.